Are you broke or don't have much money but still want to trade and make money consistently from the market? I totally get it. I started trading with just $1,000 back in 2018 and it was really tough. I blew up my account twice, and that was really hard because I was just going to college and working at Kroger, so I hardly had any money. So the money that I did have, I completely lost twice. But if I would have had this strategy that I'm about to show you in this video, then I would have actually been able to make money and grow my account a lot faster and I would have blown it up twice. But if I would have used the strategy I'm about to show you in this video, I would have actually made money and not blown up my account and would have done so consistently. So if you're ready to learn the strategy that only takes $100 and learn my risk management rules so that you don't blow up your account like I did as a small account trader, then smash the subscribe button and let's get this party started. All right, so let me explain how this $100 option strategy works. It's called credit spreads. If you've never heard of them before, I'm about to make it super duper simple. Essentially, you have a stock and you're betting that the stock will stay above that level. Wow, so hard. So let me show you this visually. Let's say you have a stock here that's trading and you're like, this level right here, I don't think the stock will go below it. If you're right, you make money. Let's say you make $20. If you're wrong, then you lose 80. That's how this works. Simply, you're making a bet that a stock will stay above a certain level. And now when I show you how to do it in the way that we're about to do it, you can have upwards of an 80 to 90% win rate with this and consistently generate money from the market. So let's walk through how this is done. All right, well, the market always works in phases. The market's either going up, down, or sideways. And again, if we want to be able to know that, we can use one simple indicator to tell us what's going on. All you need to do is access a charting platform. You can use your broker or website, whatever. I'm using TradingView.com. So let's check this out. Go to the indicator section, add on a simple moving average. So type in simple moving average. Some brokers, you just type in moving average. Either way, it works. I'm going to actually just type in moving average and simple right here. Perfect. Okay, now that we have that, we're going to go into the settings and change it. So the settings, by default, the length is 9. This means that it gets its value by looking at the last 9 candles on the chart. We want to go a bit further. We want to look at a 50 period moving average. So again, we can use 50, 200. Those are two of the most popular links. Anyways, but for this video, we will use 50. All right, for the sake of this, we know which way the market is going to go in general when the stock is above or below this line. If the stock is below this line, we're more of a bearish. The stock's going to be heading downward. If we're above it, the stock's going to go up. You can see here the stock broke above it. It trended up. The stock broke below it. It slowed down and went a bit red. You can see here below is red, above is green. A general scenario rule to follow. Okay, so now that we know the general direction that it's going and we want to bet that it will stay above a certain level, but what do? Well, simply we wait for the stock to be above the blue line. Once it is, we simply go out to the nearest support level and put on a put credit spread. So for instance, we can simply go out. So let's say this little level here, because it looks like support. Guess this is our level, and then as long as the stock stays above this, then we make money. So again, that's how we put on these trades. But let me walk through the specifics of it real fast. All right, ignore my handwriting, but really it only takes 3 simple steps and processes. Number 1, you need to identify what level do I think the stock will stay above. And we do this in a simple way. You simply take where is the stock now. Again, you want it to be above that blue line, the moving average. But once it's above that, you simply say, what level is it at? And then multiply it by 0.97. So let's do this together. Let's say that this stock is trading at $400 and we multiply it by 0.97. This means we go 3% below where the stock is, and that comes out to 388. Now again, you'll just round up to the nearest whole number if this isn't a whole number. But that means that if it's trading at 400, we're going to use a level of 388. If we use this, we'll have a really high win rate, as in the stock will hardly ever go below this level, especially when it's above the blue line. Now next we need to log into our broker and actually place this trade. This is super simple. So the way that we structure this is, now that we have this level, we know we're going to sell the first level and buy the next level. So 388 followed by buying 387. Now, why are there two levels? Well, I gave you a large overview of how credit spreads work. Essentially, you're betting on the level. But how it actually is structured is using two different options. So, for instance, let's say we're using this same example here where we're betting that the stock will stay above this level. The level that we bet on is 388, aka it's the level that we sell. So we're going to sell to open a put credit spread. What does this do? This allows us to make money as long as the stock stays above this level. However, this gives us unlimited risk by selling a naked option, by selling just one option. So we come down below this level, just $1 below, and we buy another put. What does this do? Well, it caps the amount of money we make. So before with this, let's say we would have made $5, but we had unlimited risk. Now, when we combine these together, we're only going to make probably what, $1 or less. And now we're going to have capped losses. So now we have, versus unlimited losses, now we have a loss of, let's say, $2, right? So something like that. So now that we have our capped losses, we also have capped profits, but with that gives a super high win rate. And we can bet and be right whether the stock goes up, stays the same, or goes down, but stays above our level, we still make money. That's the beautiful part of credit spreads. So we're going to place this trade. We're going to buy, or I'm sorry, we're going to sell the 388, and we're going to buy the 387. So let's actually go into a broker. So here's an example Robinhood account. Let's walk through it together. Again, you can do it with any broker. So let's say we're trading SPY, and this is, again, we're all using just fake numbers here. So SPY, and we said that it was trading at 400. It's actually trading at 446. So let's actually pull a real example here. So again, 446.12, and then again, we go out 0.97. So that gives us 432.7. So that means we're going to round up to the nearest whole number, so 433. So the level we're going to sell for this put credit spread is 433. So let's look into the SPY options chain. We're going to go into Builder. We're going to click on Put Credit Spread. In Put Credit Spread, we're going to change our expiration date to go out 2 to 3 weeks. So again, that's going to be roughly 16 to 18 days. So let's find the one around 16 to 18 days. Okay, that looks like around 14 days right here. We can take this one. See how that works? Dollar wide. Okay, cool. So now we're going to look for, what level did we have in mind? Well, we had the 0.97. So let's see if we reload that. That means the 433. So let's go scroll down here to the 433. Maybe we're going to have to do a different strike. Let's do 22. All right, 22. We'll go the $1 wide, because I know I just this works. So we're going to scroll down to the 433. 433 right here. 433. And then again, we buy the one right below it. 432 as protection. That comes up as 8 cents. So again, what does this mean? This means we can put the trade on for 7 cents total credit. That means the money that they're going to give us for putting this trade on, which means that we have the chance to make, okay, I guess it's 7, 8. So we have the chance to make $8 with the chance to lose 92. So that seems like a huge discrepancy, right? Like, we're not collecting that much money to make enough to offset losses, right? Well, I'll explain that in the risk management rules soon. But what I do want to tell you is you want to target the 10 to 12 cent range. If you get between 10 and 12 cents, you'll have roughly an 80 to 90% win rate, and you'll be able to do this on repeat. And with the stop loss rules I'm about to show you, you're going to be able to make money long term. So remember, if it's trading at 8 cents and now 9 cents, you want to collect it around 10 to 12 cents. So again, if you can't do that, then again, you don't want to put the trade on, or maybe just move up to this level and put on this trade instead. But when you put on the credit spread trade, you want to make sure it's around 10 to 12 cents. Okay, so let's recap real quick. We have a credit spread that's essentially betting that we're going to stay above a certain level. What we do is we sell a put, and then we buy the put below it to create this credit spread structure. We find our levels by going 3% below the current price, aka multiplying it by 0.97, and we want to aim to collect between 10 to 12 cents. Okay, let's say we can collect 10 cents. If we're collecting 10 cents, that means they're paying us $10 to put this trade on. That means that we are going to be able to make $10 and we're risking $90. So again, with this, we're going to have an approximate win rate of, let's just say 85%. It's going to be somewhere in this range, 85% win rate. So that means that 85% of the trades we put on will be winners and we'll make $10. 15% of the time, we're going to lose and we're going to lose $90. So how do we monitor and use a risk management approach so we don't lose $90? Because that's a lot of money compared to the $10 that we're making. Well, as we said here, how do we know this bet works? Well, like I mentioned in this example right here, all we're doing is betting that a stock will stay above a certain level. Now, again, if we hold until expiration and the stock is below our level, then we're going to hit a max loss of $90. That's a lot of money. But what if, since we're betting the stock stays above this level, that when it breaks this level, we get out instead? So that's our stop loss rule. Monitor as our stop loss rule, aka we get out when the stock breaks our short level. So what's our short level for this example? Well, in this one right here where we had it at 400, then 388. So 388, when the stock that we're trading here breaks or goes below $388, we're going to get out of our trade. This is a stop loss. This stop loss will be placed at 50 cents. So again, if we're getting in at 10 cents, then we're getting out at $50 for a loss. That means they gave us $10 to enter the trade and we're paying $50 to exit the trade, then we're going to lose 40. So with a stop loss rule, this changes from making 10, instead of losing 90, we're going to lose 40. So that's a lot better, right? And our win rate's only going to drop by about 5%. So we're going to have about an 80% win rate on this. Again, I've done the back test. If you want to do that, I have longer videos for that. But you can see here. So now that we're going to make $10 and risk 40, and 80% of the time we're going to make 10, and 20% of the time we're going to lose 40. This is a great trade, something you should take over and over and over. How do I know that? How does this work? Well, not only do I have hundreds of members doing it, but let's show you the math, because that's what's important, knowing and understanding why. All right, this is called long-term expectancy. You take the number of trades you take in times the amount you're going to win, times, or I should say minus the amount you're going to lose times the amount times you lose. So let's just say we're going to do 100 trades. So out of 100 trades, if we have an 80% win rate, that means we're going to win 80 trades. How much do we win when we win? Well, we win $10. All right. Now, out of 100 trades, if we have an 80% win rate, how much are we going to lose? We're going to lose 20 trades. How much do we lose after each time we lose? We lose $40. So that gives us, so if we get 10 cents to put on this trade, then that means that we're going to set up this structure. That means we get 10, but if we lose the trade, we're going to lose $90. And this is going to give us roughly a 90% win rate. What does this mean? This means 90% of the time we're going to win $10 and 10% of the time we're going to lose $90. So that's how this trade is structured. But that's a lot of money to lose when you're wrong, right? Like $90 compared to the $10 you're making. That means for every one loser you have to have 9 winners just to break even. So what is the risk management and rules that we're going to use? It's called monitoring. Step number 3, we're going to put in a stop loss. So what is a credit spread? What does it do? Well, like I said, it's betting that a stock will stay above a certain level. So when the stock breaks that level, we should exit the trade. That is our stop loss, when the stock breaks that level. So in this hypothetical situation where we have a stock trading at 400, we go 3% below the current price, which means we're gonna sell the put at 388. That means once the stock goes below $388, then we're gonna stop out of the trade. When we stop out of the trade, it's going to be stopped around 50 cents. So that means that we're getting in at 10 cents and we're getting out at 50 cents. So that's a net loss now of 40 cents or $40, because each spread is equals to 100 shares. So you multiply by $100 to find your real value. So now we have the same profit. We're still collecting 10 cents, but instead of our losers being $90, which is mean we hold until expiration and we're wrong, instead we're going to have a stop loss when this first level is hit, and we're going to actually have a loss of 40. So that's a lot better, right? That's literally less than half. So now this gives us roughly an 85% win rate. So our win rate doesn't actually drop too much. So again, we're 85% of the time we're going to make $10, and 15% of the time we're going to lose $40. This is a great trade to take over and over and over, especially as you're trying to grow your account, and not only that, but generate consistent monthly income as you start to scale your account to a larger value. So let's talk about risk management here and how this works, and talk about why you should take this trade when you're trading? Well, let's talk about the math here. Okay, so if we go into it, this is called long-term expectancy. So when we go into it, we basically do the amount of times we're going to win times the amount we win minus the amount of times we're going to lose times the amount we lose. All right, so let's do this. If we're doing 100 trades and we have an 85% win rate, that means we're going to win 85 trades. How much do we win each time we win? Well, like we said, $10. Okay, now we need to subtract out our losses. If we have 100 trades and we have an 85% win rate, how many trades are we going to lose? Well, we're going to lose 15 trades. 25, 15. And how much money do we lose when we lose? Well, we lose 40. So that gives us a long-term return of $250. That means that over 100 trades, we're going to end up with a net return of $250 if we're trading with one spread for all these trades. So that gives us a positive return. What does this also show you? It means that if we collect the 12 cents, 13 cents, 14 cents that you can sometimes collect with these trades, then your long-term expectancy is going to be even larger. But regardless, this is a profitable long-term strategy. And so again, how do we grow our account with this with a small account, with $100? What does this take? Well, first off, to put on one spread like we've been talking about, so putting on one spread, it only takes $100 to put on. It takes $100 in collateral to put this trade on. But I do have to be honest with you here. In order to place a spread trade, you need a margin account. By having a margin account, most brokers, especially in the US, require you have a minimum account value of $2,000. So one thing that is possible is putting in $2,000 into your broker, getting approved for margin, then removing $2,000 and trading with less. But regardless, in order to trade with a margin, you typically have to have $2,000. So although this trade can be placed with $100, you need at least $2,000 for most brokers in the US. But anyways, one broker trade requires $100. Why? Well, because that's just the collateral you put up for the trade if you're trading a $1 wide. And so again, for this, in order when we're taking the bet, we put up $100. If we're right, we get our 100 back with the money we won. If we're wrong, then again, that we just stop out. So we just close the trade early and we get our collateral back. So that's really not a problem at all. But anyways, one spread, one trade takes $100, and that's kind of how you do it. But how do you manage risk if you have the option to do a lot of spreads? Well, you want to stick with what is called the 10% trading rule, which is what we do is we take our account value. Let's say you're trading with $2,000. You multiply your account size by 10%. Again, this is the max. You should never go over 10%. That gives us 200. Now, how many spreads can we enter? Well, each spread takes $100. Divide that by 100. And this means that based on the 10% max loss rule, we can enter two spreads. So if we have a $1,000 account, in order to manage risk correctly, we can enter two spreads. And again, we can grow that over time as our account grows. You can do more if you want, but this is the recommended risk management size that I have for you. Anyways, guys, I hope you enjoyed the $100 option strategy explained video. Again, I have so much more for you. If you click the link down below, I have a very in-depth credit spreads trading strategy free course for you that goes through so many lessons of sizing, rules, strategies, and so much more that can help you become a better credit spreads trader. Anyways, guys, see you in the next video. Peace.